Okay, let me go through an example now of how activity-based costing actually works in a fictitious company. And I will start by going through a traditional costing approach and then an activity-based costing approach to help make the contrast more apparent. So here we go. Let's assume that we've got this income statement here for Baxter Battery. Now as you look at this, what's one of the first things that stand out to you? It's probably this net operating loss at the bottom, $2 million. And then you start looking at some of the other line items on here. You can see the sales revenue is $50 million. The total cost of goods sold is $41 million. Of that amount, $14 million is manufacturing overhead. Then the gross margin is $9 million. Next, the general administrative expenses, the selling administrative expenses add up to $11 million. Of that amount, shipping expenses are $3 million, marketing expenses are $2 million, and general administrative expenses are $9 million. So things aren't looking good for Baxter Battery. And currently, as it says down here at the bottom, manufacturing overhead is allocated to products using a single plant-wide overhead rate that is based on machine hours. Now, if you were the manager, what would you want to do? You'd probably want to figure out what's going on and fix it as soon as you can. A net operating loss is not a good thing to have. Well, one way that they think they can analyze things is to look at the two different product lines they have. So management wants to determine the profitability of each line. They've got a basic product line, the Sure Start product line, and that's kind of their primary product, their bread and butter product, the one that they started out with and they sell a lot of. They also have this more complex deluxe version of the battery, which is called the Long Life product line. That's a relatively newer product line, and they don't sell nearly as many of these batteries. So if they want to better understand what each of these, the profitability of each of these two batteries, they might create a segmented income statement. Now I know we've already talked about some keys associated with making segmented income statements. Let's assume that they just take this traditional approach but segment it. So they're not going to use a contribution format. Now what they would do is, if they were using the traditional approach, is they would take all of the overhead, the $14 million, and we can break that down into finer partitions. We can say of that $14 million, indirect factory wages are $6 million, factory equipment depreciation is $3.5 million, factory utilities $2.5 million, and factory building lease is $2 million. So what they would do is they would add up all those indirect product costs or manufacturing overhead costs and then divide those by the total estimated amount of machine hours. Now in this case, we're going to assume that each of the Sure Starts, and there are 800,000, takes 0.6 hours to make. And so that's 480,000 machine hours to make all the Sure Start, their basic bread and butter battery. The Long Lives, in contrast, require 0.8 hours to make each battery. So you can see they take a little bit longer, but they only make half as many. So that adds up to 320,000 machine hours for the Long Life battery. Together, there's 800,000 machine hours that are required to make all of the batteries that they sell. So in order to divide up this $14 million in a fair way, they're going to take this $14 million, divide it by the 800,000 machine hours, and they get $17.50 per machine hour. Now, you already know that this isn't the fairest way to do it, but this is the traditional approach. They're allocating all these overhead costs in proportion just to machine hours. All right, so how is this going to affect the profitability of the two different product lines? Well, we're going to take that predetermined overhead rate of $17.50 per machine hour, and then for the Sure Start batteries, we'll multiply it by the 480,000 machine hours, and that's $8.4 million that will be assigned to Sure Start. We'll take that same overhead rate of $17.50 times the 320,000 machine hours for the Long Life batteries, and that's $5.6 million. So you can see that adds up to the $14 million, but we divided it in proportion to the number of machine hours. Okay, so then what we'll do is we'll segment the income statement. It will be segmented based on the two product lines. So we've got the Sure Start batteries here, and presumably it's easy to determine where the revenue comes from, and the direct materials and direct labor. Those are all directly traceable items. And this overhead, as we talked about, we just allocated, right? So here's that $8.4 million for the Sure Start that we just allocated, and the $5.6 million for the Long Life battery. So if we take the revenue minus all the direct costs and the allocated overhead, we determined that the Sure Start battery has a product margin of $6.9 million, and the Long Life battery has a product margin of $2.1 million. And then we've got these selling and administrative expenses that are not allocated traditionally. They're not allowed to be assigned to our inventory, and so those are all expensed in this total column here. Now, just by way of review, what do they have going for them in the segment and income statement? Well, they do have a segment for the two different product lines and a total column, and that's really good because this allows them to put costs on here that don't really make sense to be divided up between the two product lines. Now, I'm not saying it doesn't make sense to divide up any of this 11 million, but hey, at least they have a column for each of the two products and a total column. All right, so anyway, you can see they've got the same $2 million loss, but it looks at this point like both batteries have a positive profit margin that are helping to pay for the selling and administrative costs. All right, now let's contrast that approach with product margins based on activity-based costing. Okay, so what we're going to do, first of all, if you remember the 5 steps for activity-based costing, the first part of the first step says identify all the activities. Okay, and we'll assume that they did that. Realistically, this would be a huge project, a huge undertaking. Let's assume they did that. Then the second step is to create cost pools based on different aggregations of those activities. They've already done that as well. Okay, so we've got these 5 different cost pools here. Customer order activity cost pool, design changes cost pool, order size cost pool, customer relations cost pool, and other cost pool. And then the third part of the first step is to select a cost driver. In this case, it's called activity measure. And they've already done that as well. So for customer orders, they're going to allocate costs based on the number of customer orders. For design change cost pool, it'll be based on the number of design changes. Order size based on number of machine hours. Customer relations based on number of active customers, and other based on not applicable. In other words, these are some costs that they don't think would be useful to assign. They're organization sustaining costs. To give us a little bit better understanding of what these cost pools make up, we've got these details here. So the customer order cost pools assign all costs of resources that are consumed by taking and processing customer orders. What type of activity is this on the cost hierarchy? We'd probably say it's a batch level activity. All right, when they process customer orders, that'll probably be done as a process one order that is a batch of batteries at a time. We could also say this is a customer level cost pool probably. We've got design change cost pool, assign all costs of resources consumed by customer requested design changes. So this could be either a customer level cost pool, or it could be a product level cost pool if design changes are only created, these changes are only made for one type of product. We've got order size cost pool. These are assigned all the costs of resources consumed as a consequence of the number of units produced. So because it's based on number of units produced, this is a unit level activity, unit level cost pool. Customer relations cost pool, assign all costs associated with maintaining relations with customers. This is probably a customer level cost pool. It will vary based on the number or type of customers they have. And then this other cost pool that is assigned all organization sustaining costs and unused capacity costs. So as it says there, it's organization sustaining cost pool. Okay, so that's the first step in ABC. The second step is to take the indirect costs, not only the overhead costs of $14 million in overhead, but all the indirect costs, so some of the selling and administrative costs, and assign those to the activity cost pools. So we can see we've got a little bit finer, we've got these indirect costs partitioned out into some finer details here. As we already talked about, the manufacturing overhead is divided into indirect factory wages, factory equipment depreciation, factory utilities, and factory building lease. General administrative department costs are based on administrative wages and salaries, office equipment depreciation, administrative building lease, and then the marketing department based on marketing wages and salaries and selling expenses. So the total overhead cost, we'll call all of this overhead, is $22 million. Okay, it's made up of manufacturing overhead and selling and administrative overhead, indirect costs from the selling and administrative activities. Now what about shipping costs? Why aren't those on here? Well, we're going to assume that direct materials, direct labor, and shipping are excluded from this here because they are directly traceable to the products or the customer orders. Those are direct costs, and we only need to deal with indirect costs here. All right, so what we need to do is we need to take this 22 million and somehow divide it up in a logical way to our 5 different cost pools. So here's what we're going to do. We're going to somehow determine, if we just look at this one at a time, indirect factory wages here, we want to determine how much of the indirect factory wages costs should be assigned to these 5 different cost pools along the top here. Okay, so I guess I should start out by just kind of describing what's on this table. We've got in this first column here the different line items for our indirect costs, and then in each column we've got a column for our different cost pools. All right, so customer orders, design changes, order size, customer relations, other, and then the total. And then each line here you can see adds up to 100%, and basically what we're doing is we're determining that 30% of these indirect factory wages are associated with activities in the customer order cost pool. 30% associated with activities in the design change cost pool, 20% in the order size cost pool, 10% customer relations cost pool, 10% in other. All right, and then we do that for each one of those. Now, how do they get these percentages? Well, there's a couple of approaches. One is you could have engineers kind of watch people and see how much time they spend doing each different types of activities. Another more cost-efficient way of doing things is just to survey the employees and find out how much time they think they're spending on activities that are related to these different cost pools. And that's my understanding is that's typically what is done, because the other way is just too costly. You have to pay someone to come in and watch what everyone does and catalog that. All right, at any rate, there is one practice problem that will ask you to do this, but these percentages will be given to you. All right, so we'll take these as given. What we'll do with these now is we'll use those percentages to take each of these different indirect costs that we just tabulated, the 22 million, and we'll multiply each line item here by the corresponding percentage in that table on the previous slide. So for example, the $6 million in indirect factory wages will be multiplied by 30%, so that's $1.8 million. That 30% is based on this 30% right here. All right, so that's $1.8 million. And then you would take that 6 million times 30% to go in the next cost pool here. And then you go all the way across, and then you move down to the next line item of indirect cost, factory equipment depreciation, 3.5 million. We're going to multiply that by 20%. Again, that's 20% from the table in the previous slide. So that's $700,000 that's assigned to this factory equipment depreciation. And we would basically repeat this for the whole table. Of course, doing this by pencil and paper would take a long time, but someone would probably set this up in some sort of Excel spreadsheet or enterprise resource planning software, and it would, of course, make this much more automated. But at any rate, what we have now in this table here is the total amount of cost of that $22 million in total indirect cost. Based on that allocation process, $4.52 million is going to be assigned to the customer order cost pool, $3,040,000 to design change, $5.2 million to order size, $3.08 million to customer relations, and $6.16 million to other. All right, so that's the second step, is just taking that $22 million in indirect costs and dividing it up to the 5 different cost pools. All right.